Hello and welcome to this video where this time we'll be looking at Chapter 16 on standard costing, similar to Chapter 15 in that there's no lecture video. We're going to do the same thing with Chapter 16. It's another one of those chapters where you really don't want to listen to someone talk on and on and on about it. You need to see numbers and jump right in and start messing with the numbers because all of this, it's just basic algebra. So for standard costing, companies will develop budgeted amounts for materials, labor, and overhead. And they call these budgeted amounts standards. So they'll have their engineers and the production managers do time studies, and they'll do a bunch of research, develop prototypes to determine how long it should take them to make 1 unit of product. How much material do they need to make 1 unit of product? Then we look at the overhead rates needed to make 1 unit of product, and they'll develop realistic standards, not ideal or perfect standards, but realistic standards. And then those standard amounts will be recorded in the journal entries as materials are issued into production or labor is charged to work in process, all those different things. Well, the problem with standard costing is that the actual amounts usually differ from the standards. So at the end of the period, we do an analysis to make sure that we've met our targets. Usually we haven't met our targets. And that analysis is called variance analysis. In variance analysis, we look at the difference between our actual product cost, actual price, and our actual quantity, how much we use. When we perform this analysis, we'll develop or calculate 3 different variances. Usually there is a price variance and a quantity variance, and then we can combine those two to develop what's known as an overall variance. Now, the terminology changes a little bit when we're talking about labor versus material versus overhead, but it's still the same concept. Either we've spent too much money or we've used too much of our product or our raw materials, or either we've spent too much money or our employees work too long, something of that nature. So we get to break down the variance to determine why we overspent or why we underspent. When we calculate our variances, we'll examine them to determine if the variance is favorable or unfavorable. So this requires some subtraction. When we do that subtraction, of course, we're going to get either a positive or a negative number. If the number is positive, it is actually an unfavorable variance because we're talking about spending money here. We're talking about materials, labor, and overhead. So if we overspend, then when we subtract, we're going to get a positive number. So in this case, negative is bad. Excuse me, positive is bad. Blah. Now, if the number is negative, because we're talking about expenses, it represents a cost saving. So a negative number is a favorable variance. Again, this makes more sense when we see this with actual numbers. Now, the way we do this variance analysis is we'll find the actual price and multiply it by the actual quantity for materials. And then we'll find the standard price and multiply it by the actual quantity, and then take the difference between those two numbers. Once we subtract those two numbers, that is going to give us our price variance. For the quantity variance, we take the standard price times the actual quantity, and we subtract the standard price times the standard quantity. And then that's going to give us the quantity variance. And again, we combine those two, and that will give us the overall variance. Now for labor, click to the labor tab. Instead of having a price and a quantity variance, we call it price and efficiency. If you still want to use quantity, you can. Some books, some companies will use a rate variance instead of price variance, but it's the same thing. It's about how much we had to pay our employees per hour. Whereas efficiency is about how many hours they actually worked. And then we apply this variance analysis to overhead. And with overhead, we break it out between variable overhead and fixed overhead. The variable overhead calculation looks very similar to what we do for labor and materials. We end up having a price variance and a quantity variance, but we call it spending because it's about how much money we spent. And then efficiency variance. That efficiency variance varies based on how we calculate our predetermined overhead rate. If we calculate the predetermined overhead rate using hours, then we're talking about working more hours. If we calculate it using units or machine hours, it just depends on what the denominator is for the predetermined overhead rate. But then for fixed overhead, everything changes. Instead of doing all this multiplying, we have the actual fixed cost, the budgeted amount, and then the standard. The standard is actually, again, based on that predetermined overhead rate. We still have favorable and unfavorable variances. And instead of calling it price and quantity, we call it fixed and uncontrollable. The reason why we call this for fixed overhead uncontrollable is that it's all about the predetermined overhead rate. It's not about whether or not we were more efficient. It's just a matter of we produced more units than we budgeted or fewer units than we actually budgeted. So when it comes to figuring out, hey, why do we have these issues? We sort of ignore the uncontrollable variance because we can't control it. So that means when it comes to overhead, we'll end up adding together the two variable variances and the one spending variance for fixed overhead, and we combine those to get the controllable overhead variance. Now, let's take a look at our problems here, because what I did was I created this spreadsheet that if you populate the shaded areas here, only I don't think I locked these cells. If you populate the shaded areas here, then it fills out the table for you. Now with the table, we're multiplying here, but then once we get these two numbers, we take the difference between those two. You'll see that as we populate. Now you don't have to use the table. It's a great option because a lot of this is just simple algebra. For quite a few of you, you're going to be able to look at this and you're going to be able to calculate in your head immediately what the variance is. But I'll show you both ways. I'll show you using the table and I'll show you using the shortcut algebra way. So in this video, we'll do this demonstration problem and then we'll double back and look at the exercises for chapter 16 so that you can get more practice. But we look at this from the standpoint of materials, labor, and overhead. So let's look at materials first. So we have this problem, and in this problem, we don't even get any words. I don't know what we're producing. Maybe we're making golf clubs. Who knows? But I have my standard cost. This information is given. It's been developed by the company's engineers. And I know that it takes 4 pounds per case. So whatever it is, I'm selling it in cases. I don't know, maybe it's lemonade. Who knows? 4 pounds is required to, 4 pounds material is required to make 1 case or 1 unit. We look at things in terms of cases. And we believe it should cost us 55 cents per pound. When we multiply that out, it gives me a standard cost of $2.20 per case. I want you to put a big old X through that. Ignore the $2.20 because that is not what I need. I am looking at materials from the standpoint of how many materials I use. So my unit of measurement is not going to be cases or units. It could be pounds. It could be square footage. So the information that I really need is the number of pounds needed to make 1 unit of product and the cost per pound. The focus is on pounds here. All right, I also see that we produced 80,000 units in August, and the actual materials purchased and used were 328,000 pounds and 60 cents per pound. So what I want to do first, and this is whether you are doing it the algebraic way or you're using the table. What I want to do first is to find the actual price, the actual quantity, the standard price, and the standard quantity. The actual price is not in total dollars. I don't want it in total dollars. These are per unit when it comes to actual price. So I need the price per pound. And I was told here the actual materials purchased and used, 60 cents per pound. So for actual price, I'm going to put in 0.6, not -6, 0.6. There we go. Now for the actual quantity, same thing. I don't need the full dollar amount. I'm talking about pounds of material here. So we used 328,000 pounds. Now for standard price, here is my 55 cents per pound. Remember, not the $2.20, that's per unit. I'm looking at this from the standpoint of material, so I need per pound. So it's 55. And then for standard quantity, I see here that it says I need 4 pounds per case. So now it's time to stop and do a common sense check. Because here's the deal. The standards are my budgeted amounts. The actual is what really happened. I would expect to compare apples with apples and oranges with oranges. In other words, these numbers should be pretty close. So for actual price compared to standard price, I wanted to pay 55 cents and I ended up paying 60 cents. Okay, I paid 5 cents more. That's reasonable. But look at quantity for a second. For actual quantity, I had 328,000 pounds, but standard quantity, I had 4 pounds. That makes no sense. For my standard quantity, I always have to take the extra step and take the standard quantity per case and multiply it by the actual number of cases produced during the period. So standard quantity is the one that will trip you up every single time. Make sure you do your common sense check to ensure that you're comparing apples with apples and oranges with oranges. So 328,000 is a long way from 4, but if I take the 4 and multiply it, let me do 4 pounds per case, and then I multiply it by 80,000 cases, the actual number of cases, it should be a little more comparable. All right, that's better. 320,000 versus 328,000. So I used 8,000 more than what I planned to use. Now let's see how we use these numbers. Let's see how this table populates because it spits out the answer, which is great. But I want to make sure you understand it and you can do your quick common sense checks here. All right. So we start with actual price and we multiply it times actual quantity, and then that gives us a dollar figure. This is the same dollar figure that was given here, but we want to put it in the formula because over here I have to pull out actual quantity again. So I want to make sure that I'm using my price per pound and the actual number of pounds. Then I take that standard price and multiply it by the actual quantity, and I get a number. I compare the actual with the standard. Notice that quantity remains the same, right? So if I turn this into an algebraic equation, I'm simply taking the difference between what I wanted to pay and what I actually paid, and I'm multiplying it by what I actually used. And when I do that, I get 16,400, or I can do the 196,800 minus the 180,400, and I get 16,400. Now you want to make sure that you are subtracting the standard from the actual, because that way your negatives and positives will tell you the truth. Remember, a positive represents us overspending. A negative represents a cost saving, so we like negatives. So this price variance is unfavorable. Now let's look at the quantity variance. We said we wanted to use 320. We used 328. So I have my number already here. I already multiplied 55 cents times 328, but now I need my standard, 55 cents times 320. And then we take the difference between those two numbers and we get 4,400. Now, another common sense check. Let's see if this makes sense, because I can rationalize this. I can make this completely logical. So if I said I wanted to pay 55 cents per pound and I ended up actually paying 60 cents, that's bad. I spent more. That's unfavorable. So if I do a little quick math here and I take 0.6 minus 0.55, and then I multiply that by the actual quantity. Oh, hold on. There we go, 328. I get 16.4. And notice that 16.4 is my price variance. So do you have to populate the entire table? No, as long as you know what it is that you are trying to find. The common denominator when you're trying to find the price variance is actual quantity. You're taking the difference between actual price and standard price and then multiplying it by actual quantity. Now let's do this same thing with the quantity variance. With the quantity variance, my common denominator here is standard price. So whatever I do, I'm going to multiply it by standard price. Now, with quantity variance, I wanted to use 320, but I ended up using 328. So I always want to take my actual and subtract out the standard. So I know I used 8,000 too much. So 328. Oh, I forgot my equals. 328. Oh my goodness. Minus 320. That's what I get. I should have just put the 8,000 in there and then we'd be done by now. And I'm going to multiply that times my standard price because that's my common item there. And I get 4,400. Unfavorable. Now, the question is, from an analysis standpoint, because we know how to calculate the numbers now, but from an analysis standpoint, what does this really mean? If we overspent and we overspent fully by 20,800. A portion of that was attributable to the fact that we paid more than what we planned to pay. And a portion was because we used more than we planned to use. If it's because we paid more, maybe we had to do a bunch of rush orders because scheduling was poor. So we kept running out of materials. And when we had to do the rush order, we had to pay extra for the shipping. Maybe the purchasing department ended up not taking advantage of the purchase discounts and they ended up paying later. There are a lot of things that could have gone wrong. From a quantity standpoint, it could be that we have employees in the factory that don't know what they're doing, so they end up wasting materials. It could be that the purchasing department tried to save some money and they ended up ordering cheap materials. So we had to use more than what we planned to use. But we use these variances to help us determine, hey, why did we overspend so that we can solve this problem for the next period? Now, let's look at direct labor next, using the same concepts here. So now for direct labor, I have my standard costs of 0.05 hours per case. And I always forget how many minutes that is. Is it? Let me see. No, it's not that. 3 minutes. So 3 minutes to make one case. And we pay $1 per case, but it's $20 per hour. That's my hours worked, the actual labor cost, and the average cost per hour. So looking at this already, I can tell whether or not some things are favorable and some things are unfavorable. So looking at this real quick, we can see I wanted to pay $20 per hour. Oh, we ended up paying 18. That's pretty good. That one should be a favorable variance when it comes to my rate or my price variance. Now, when it comes to hours, we have 4,400 hours worked. And I'm going to have to compare that to my standard hours because I said it should take me 3 minutes. So whatever 3 minutes times 80,000 cases actually is, that's going to give me how long it really took me. Now, let's plug this information into our table here. For actual price, we know it's 18. And for standard price, we know it's 20. Now I need to do my quantity. For my actual hours worked was 4,400. And then for standard quantity, I'm not going to use it in minutes. I'm going to use it as they gave it to me, 0.05. And it's time for my common sense check because 0.05 does not compare to 4,400 hours. I have to remember to multiply this 0.05 per case by the actual number of cases that we produced of 80,000. So now let's see if that's comparable. What did I say? 80,000. That's better. 4,000 compared to 4,400. So it looks like we worked 400 extra hours. So let's see our variances here. For the price variance, it's favorable, it's negative. You don't have to put the negative in. You can just indicate that it is favorable. I like to keep the negative in because it keeps me on track. And I expected it to be favorable because I wanted to pay $20, but I only had to end up paying $18 on average per hour. So that's great. But it took them a longer time to work. Maybe I had less skilled workers, so it took them a longer time to finish than it would a high skilled worker, but I ended up paying them a lower rate, so that's okay. I don't know how that impacted the quality of my product, but it definitely shows that it took me longer than I planned. So now I can do my quick common sense checks, or we can do it the algebraic way. For the price variance, I know that I have a $2 difference here in my rates. The 18 minus the 20, and I know it's -2. And I can simply multiply that times the common factor here of actual quantity of 4,400. And then I see the 8,800 matches. Now, for the efficiency variance, I see I have a difference of 400. I wanted to take 4,000 hours. It took me 4,400 hours. So 400 times, what do I have in common? Standard price of 20. And 8,000. And that takes care of direct labor. Once you get into the groove of direct materials and direct labor, it makes variable overhead that much easier. Let's look at variable overhead. Now for this one, my problem is just a tiny bit different. Here we go. Here's all the information I need. So I have my standards, my 3 minutes or 0.05 hour per case. $12 is my rate. I ignore that $60 per case. I don't need that. Notice that the $12 is the variable production overhead rate. The number of cases produced in August was still 80,000, and the actual variable overhead cost in August was 53,860. So for this one, they kind of organized the information in a bit of a different way, but that's okay. I can find what I need. All right, let's do variable overhead first, and let's fill out our table. For the actual price is not given to me, but I do believe that I can find it. And we know that overhead is based on hours. These hours here, 0.05, should look familiar. It's the same as direct labor hours. So the way we apply our overhead is on the basis of direct labor hours. So we actually have the actual number of direct labor hours that were worked, or can work backwards to find it by looking at the previous problem. Now, do I really need this information to do this problem? Not necessarily. When you see a problem, because this was one big cohesive problem altogether, so you would know that everything was working together, and there would have been a sentence that says that overhead is applied on the basis of direct labor hours. You would know how to find the actual quantity. For this problem, because I have to piecemeal things together, that sentence was omitted, but variable overhead is applied on the basis of direct labor hours. And from the previous problem, when I did direct labor, the actual quantity was 4,400. So it's going to be 4,400 again. Now, the reason why I put that one in there first is because for my actual price, they don't give me my price per hour. And that's okay, because I have the actual overhead costs. So this time I'm going to take the 53,680 every now and then. The problem will not be straightforward, and you'll have to piecemeal things together. 53,680. And we're going to divide that by the 4,400 hours. You have to piecemeal things together. But the point is, the 53,680 is the magic number that I want to show here. And for me personally, this is why I don't take the shortcut of using the algebraic way, because if information is missing, it's difficult for me to visualize my missing piece. But if I have the table, every single component is there, so then I can visualize the missing piece. But whatever works best for you. 53,680 divided by 4,400. Must not have typed. I did not. 53,680. I put in 580. Okay, there we go. Because that 53,680 should automatically show up right here. Had the wrong number in there. Now, let's move on and let's continue to populate our table. For a standard price, we know that the predetermined overhead rate for variable overhead is 12. Oh, that's comparable. That 12 is comparable to 1220, so we overspent. And then for my standard quantity, it's going to be the same standard quantity for direct labor. How do I know? Overhead is applied on the basis of direct labor hours. So it's still the 4,000, or the 5.05 hours per case multiplied by the 80,000. 0.05 times . All right, so when we plug everything in, notice that we have our spending variance of 880. That is unfavorable, and we predicted that it would be. For the efficiency variance, we know that we worked 400 hours more than what we planned, so that also impacts our variable overhead. So we end up with an overall overhead variance for variable overhead of unfavorable. Now, let's look at fixed overhead, because this is where it gets fun. When it comes to materials, labor, and variable overhead, we're using the same pattern. But for fixed overhead, it changes, because now we need to pull out the actual amount of fixed overhead that we spent, the budgeted amount, and then the standard amounts. Let's see. So for our standard, notice we're still using direct labor hours, 0.05 hour per case. And we have that $12 is the variable production overhead rate. That's good to know. Actual number of cases, and then the actual variable overhead. But down here is where I need to pull out the information to help me to be able to deal with fixed overhead. So there's a lot of information here. And notice that the number of cases produced in August tells me which budget I need to look at. So I have my actual information based on activity of 80,000 units. And then I have the flexible budget based on activity of 80,000 units. Now, why am I over here? What in the world is all this information? What are they talking about? Well, this tells me the actual amount that I spent for fixed overhead. So usually when it comes to fixed overhead, I have to look at some type of profit variance analysis or some type of table that tells me what the actual fixed overhead amount was. And I find it here in the amount of 195,500. So let me plug that in. I'll put it in the right cell. B14, need to put it here, 195,500. And then for the budgeted amount, I look at the flexible budget and I see based on the same activity level that we had, we were looking at 200,000. So that amount goes into the budgeted category. And then for the fixed overhead, the standard price and the standard quantity is a little bit different here. Because for the standard price, we're going to base that on the number of units. Because notice that we planned for $200,000 in the flexible budget. But in the master budget, we had planned activity of 100,000 units. So that means the rate that we would have used would have been based on what was in the master budget. So that 2 that I already have plugged in there, I guess I forgot to delete it from something I was doing before, is the budgeted amount divided by the 100,000 units. Now, what this problem is missing is some additional words to be able to tell me all of this. That's why we'll do another problem in a bit on the fixed overhead, because this one can be a little bit confusing. But we needed to pick up the master budget amount for the standard price here. Now, for the standard quantity, it's the actual number of cases. I'm comparing apples with apples. For variable overhead, yes, we used labor hours, but for fixed overhead, we're using units. So 80,000 is my magic number here. So now we can see, as far as the spending variance, we came in under, and we're happy about that. As far as the uncontrollable variance, we don't really care. We budgeted for 200,000, but we actually produced 80,000. I would expect this to be lower. That's totally fine. When it comes to comparing the budgeted to the standard, don't worry about this one. It's uncontrollable anyway. It's the production volume variance. What we really want is the controllable variance. What can we do to make sure that we're spending the amount that we need to spend in overhead? And remember, the controllable variance combines, let me show you that. It combines my 2 variable variances and the fixed spending variance. All right, if you don't need any more problems, you feel good, by all means, go ahead and start on the homework. But I'm going to continue the video if you need more reinforcement for materials, labor, and overhead by looking at the chapter 15 and 16 problems. So we already did the chapter 15 problem. So let's keep going so that we can see something where the information is organized a little bit differently. We're still going to do this from the standpoint of materials, labor, and overhead. All right, so we have the standard direct material cost per unit for Willis Group was 124 at $31 per gallon times 4 gallons per unit. Remember, I don't care about this 124. I care about the 31 per gallon because that's going to be my standard price, and the 4 gallons per unit is going to be my standard quantity. During the period, we have actual direct materials costs of 163,540, and materials used totaled 54,440 gallons, and 13,200 units were produced. We have to find the material price and efficiency variances. And the exhibit 16.10 for the formats used is the same format that I have given you on this table. So let's go ahead and start filling out the information that we need. The actual price, and you don't have to start it in any particular order. I'd rather do standard price first because that one was given to me first, 31. The standard quantity, I know, is always or generally multiplied by the number of units produced. So it's not just going to be the 4 gallons per unit. It's the 4 times the 13,200. Now, the actual price during the period, actual direct materials costed, they didn't give me that number. Let's see. Materials used was 55 or 40, which when I look at that, that does compare to the 52,800. I ended up using a ton more materials than what I expected. For actual price, in order for me to be able to use the table, I do need to divide to find the actual price. On a technicality, they have given me actual price times actual quantity. That's that 1.6 million and some change. But because I like for my table to be perfect, I'm going to work backwards, and I'm going to expect to see this magic number here show up right here. So let's see. So it should be 1,635,480, and all of that is going to get divided by 55440. So we're going to divide that by the actual number of gallons. And now let's put the formula in there. One six three five four 1,635,480. Great. Now everything is already done. Let's see if it actually makes sense. I wanted to spend $31 per gallon, and I ended up spending 29. That's great. Favorable. Now, I wanted to use 52,000 gallons and some change, but I ended up using 55. Unfavorable. Good. I can confirm that. And there you have it. Let's look at. Oh, I forgot to do the shortcut. Let's do the shortcut. The shortcut would be for the price variance, the 31 minus the 29.50. Minus 29.50. And then all of that gets multiplied by the actual quantity. That's the thing we have in common there. And it would be nice if I turn this into a formula. And I get 81,360. Let's see. Oh, but I subtracted the wrong way. Let me fix that. Have to make sure that I subtract the standard from the actual. So actual goes first, 29.5 minus 31. There we go. Now, for quantity variance, again, it is actual first. So it's 55,440. Got a formula, 55,440. And I subtract out the standard quantity of 52,800. And then that gets multiplied by what I have in common here. And what I have in common is standard price, so 31. And 81,840. Great. Let's look at labor next. For labor, records at the Farnsworth Corporation contain the following data for the most recent period of activity. We have actual direct labor costs, actual direct labor hours worked. Oh, they're working backwards. Look at them. Standard direct labor hours allowed for the actual output, direct labor variance, and that's price variance, actual variable overhead, and the standard variable overhead. Wait a minute, did I do labor? Oh, this one isn't even labor. Where's labor? Let's see. I'll see what they asked me to do. Oh, it is. Oh, good. We get to, I hate to use this analogy, but kill two birds with one stone. If you like birds, I'm sorry, I don't mean to be rude, but that's the analogy that I'm just trying to say we get to do labor and variable overhead at the same time. All right, so let's deal with our labor first. I think that's the one I want to do first. Let's fill in what we can actually find. So actual total direct labor cost was $468,100. So that means that $468,100 needs to show up there at some point. Let's see what else I have. Oh, I have my actual hours worked, 15,100. So if I know my actual hours worked and I know the actual cost, I can find the cost per hour by taking the 468,100 and dividing it by the 15,100. Again, make it a formula. 31. There we go. I didn't want that one to be a formula. There we go. 468,1 and 468,1. All right, the standard direct labor hours for the actual output was 14,2. So I don't have to multiply that time. That 14,2 compares to the 15,1. And they gave it to me that way because they gave me the standard direct labor hours allowed for the actual output. So they're telling me that they already multiplied. Now I'm looking at a price variance of 45,300. So I'm way off there. And then they want to start to give me my variable overhead stuff. So now for standard price, I wonder if I can find standard price. Did they give it to me? Nope, they don't give it to me. So how in the world am I going to find what is missing? Well, now here's where the algebraic version of things comes in quite handy because I know what the price variance is. The price variance is 45,300 and it's favorable, so it is negative. In theory, I should be able to take the 46,100 and subtract whatever this magic number is to arrive at the price variance that was given to me. That, what was it? 45,300. Once I find the X that is missing, I can then work backwards to find the piece that is missing here. So here's what we're going to do. We're going to take the 468,100. And we're going to subtract X. And then we're going to set it equal to the negative 45,300. And make sure I'm picking, yes, the negative 45,300. And now we're just going to solve for X. So in solving for X, we find that X is equal to 513,400. And I know that because I am adding the 45,300 to both sides, and 468,100 plus 45,300 is 513,400. So that means this number right here needs to be 513,400. How do I get it there? Well, in order to get it there, I'm taking X and I'm multiplying it by 15,100. So now I'm going to take 15,100 times x and set that equal to 513,400. And when I solve for x, that's how I find my standard price of 34. And you know, when I'm solving for x, I'm just end up dividing the 15,100 by both sides. So that 34 now gives me my missing piece, and I can fill out the rest of my table. And look at my table. The variance is what they told me it would be, negative 45.3. Standard price times actual quantity is a 513,400, which is the number we found. And once we were able to find that standard price, it filled in everything else for us. So we were able to find the labor variances here. I think I'll do the variable overhead variances. I think I have a pretty big problem that handles all of the variable overhead variances on the next one, because I don't want to have to copy and paste over the formula. So we're only doing labor for this one. Now let's try the last one. For the last one here, we have Weatherby Tech Services, and they're a chain of computer maintenance technicians for households and small businesses. The following data are available for last year's services. We have the number of tech calls, then we have the budgeted tech calls, averaging 90 minutes each, and then we have standard variable labor and support costs per tech call as follows. So there are my labor costs there. And then I have fixed overhead costs as well. We need to prepare a cost variance analysis for, we're primarily just going to focus on variable and fixed costs. We're not going to do it for every single one, just for variable and fixed costs. So let's deal with variable costs first. For my variable costs, I see that my standards are as follows. For variable overhead, 30 minutes at $24 per hour. So my standard price for variable overhead is 24. My standard quantity is 30 minutes, but it's 30 minutes for the actual number of tech calls, or multiplied by the actual number of tech calls, or 120,000. So I'm going to take 30 minutes, or half, times 120,000 tech calls, and we get 60. Now, let's see how that 60,000 compares to everything else that is going on here. Because for actual, notice that the actual calls average 40 minutes per call at $22.50 per hour at 120,000 calls. So those are my actual amounts. So the actual price is $22.50. And the actual time was 40 minutes instead of 30 minutes. So 4/6, or 2/3, times 120,000 gives me 80,000 hours. So that's 10 minutes longer per call. So I was expecting that to be more than what I actually planned for. So in looking at my price, I wanted to pay 24. Oh, I paid $22.50. I expect that one to be favorable, and it is. Great. For this one, I wanted to spend 60,000 hours, but I ended up spending